So this is great for the business for RCM China. This is great for in terms of the relationship that you mentioned. How does this translate into, is it better execution for offshore investors? Is it lower cost of execution for offshore investors? Regulatory, is it more challenging to use an offshore counterparty or offshore execution partner accessing onshore China? Yeah, I'm just thinking of alternatives, right? Like running swaps, for example. We have plenty of managers who are running swaps rather than going onshore. Maybe you can walk us through why go direct? Not to use the Michael Dell quote, but why go direct?
Yeah. So I think there's four different ways to access China. And I'm probably, let's say your audience, I'm not encouraging drinking, but if they take a sip of a beverage every time I say access is key here, it's not as much finding alpha, it's access. So there's four different ways in my eyes to access China. You had mentioned one, swap. When we started exploring China, again, around 2018, pricing swap fees were around 700 to 800 basis points. Very expensive. There has been a compression in fees, probably access swap for 200 basis points. How it's priced is depending on your margin usage and your portfolio turnover, there's a commission, and then depending on the notional size of the book. So there's a couple different components. A more active trader is going to pay different fees than a slower moving trend follower. The execution is not as smooth. It's been my experience, and I'm not singling out any one entity, just execution and swap is general. A couple of years ago, I don't know if it was 2021 or 22, of the swap desk that we were communicating with said, hey, we're taking off for 3 or 4 days for Christmas. You have to go flat or you're not going to be able to trade. It's unheard of and unacceptable to tell a manager he's not going to trade for 3 or 4 days in a global market. Makes no sense to me. QFII, which laws just changed, another access point in Q4 of last year. What makes this exciting for me is the QFII scheme now allows foreign investors to access local PFM, the equivalent of an onshore hedge fund, and it also allows global investors to access commodities. Now, it's not the full suite of markets. There's QFII approved markets. That's approximately 25, 24 markets, and that list is growing. But it's super liquid markets in the mainland, which we are accessing RCM China through our WOFE. It's about 75 to 85 markets, about a third of the markets. Now, in 2018, when we established our WOFE, I thought that was the clearest path. Laws have changed. There's a lot of corporate red tape. It just isn't as easy to do what we did in 18, 19, of setting up a WOFE, moving money in country, as it was 4 or 5 years ago. It's very counterintuitive. You'd think it would be easier. I personally think that the government has an agenda, and they want you to access markets different ways. And then finally, the fourth access point is the internationalized markets, which is about a dozen markets. Half of them aren't liquid, but global investors can access a number of markets. You have some prop traders that are participating in arb trade with some of the metals or agriculture or energies, perhaps trading China local markets against LME or CME. That's been a trade that's been working for several years.
Yeah, but half a dozen, that's hardly it's not a well-diversified strategy with just half a dozen markets, right?
Agreed. That's why you find a lot of prop traders or specialists that may pick 2 or 3 markets. But yeah, it's not a scalable business in my eyes. Really, if you want to put size into the Chinese commodities markets, I think you have 2 options: access via QFII or access via total return swap.
I get the sense you mentioned running almost as a prop book, running capital through a WOFE, which is a wholly owned foreign entity, into China. There have been anecdotal cases of issues getting capital on and offshore because the WOFE vehicle wasn't really intended for liquid movement of capital on and offshore. So are you saying that the QFII structure is built more for this type of strategy, meaning you can take money on and offshore? As an investor, I can redeem freely from onshore markets?
Yeah, that's exactly right. Eloquent, better than I could have said it. The QFII scheme is in the up and up. There's more and more trading firms, banks, institutions that are applying for it. And that to me is the cleanest path for a global investor to access alpha in China. Now, for several years, you've been able to access equities, bonds through whether it be Stock Connect or Bond Connect. But as I alluded to, my world that I live in, private fund managers and commodities, the laws just changed last year. Over the last 5 years, RCM has been able to, in country, raise and collaborate with in the neighborhood of 175 million USD equivalent from mainland PFMs and MOMs. I'm going to go out on a limb and say over the next 24 to 36 months through this QFII scheme and working with global investors, both traders and managers looking to access China, I think much more money than that 175 million will be raised. And why I see that being the case is I talk to traders every single day, and there are a number of large managers that have done analysis on the Chinese markets, and because there is that non-correlated alpha markets that don't trade elsewhere, they can buy access in China, expand their capacity. So think of it from a manager's seat. They're charging a management fee based on their AUM. If they can expand their capacity, that's a win. And they get an incentive fee based on their returns. If they can get access to non-correlated markets and increase their returns or even smooth out their returns, that's a win. So I think that will be a major trend in the next 24, 48 months, over the next 2 to 4 years. I think you're going to see any global macro big trader that I'm talking manages north of, call it $500 million. If they ignore China and don't look for the best path for them, they're going to be left behind by their peers. Large groups, thought leaders like Milburn, Winton, AQR, Aspect. There was just an article on Bloomberg last week. Aspect is setting up a Shanghai office, and I think they just made 2 strategic hires. You have very large global traders that are either already in China or looking to go to China. And then I'm in deep conversations with a number of them that are potentially looking to help use or collaborate with RCM and OP to help guide them. Again, because you live in Hong Kong, you have a platform. Okay, I've been in China for 5 years. So just I'm partnering with thought leaders in China. They're partnering with groups like you and groups like me that are drinking the China Kool-Aid and believe in the future.
We're still on that Kool-Aid, despite markets bottoming out 3 times in the last 2 years.
But when you discuss markets, this will be very quick, and then I know you have a very smart question, but when you discuss markets, I look at a tale of 2 markets, because if you look at the US markets, we've been on a tear in the stock market. The NASDAQ's up, the Russell's up, interest rates are moving higher. The other side of the coin is China. Interest rates aren't moving higher. Their stock market's not up, it's down. You have a real estate bubble that's already burst. Again, it tells that story about diversification and non-correlation.
When you look or when you speak with allocators, I know you cover both North America, Europe. Do you see a difference in their appetite for China, partly between the 2 continents and the type of investors? And then also, are we seeing a shift in that in recent few months, or is it still very, very uninvestable?
We are not soliciting US investors at all, not even talking to them about China. So my target market is investors in Singapore, investors in Hong Kong, investors in Europe, investors in the Middle East, investors perhaps in Canada, Mexico, again, a global footprint. And there's conversations. A lot of the people I talk to from an investor standpoint still think there's hair on it. Obviously, you had on the onset mentioned something about geopolitical issues. They still exist. But when I started down this path, you had Trump, you had trade wars. Now China will or will not invade Taiwan. I view all this as a distraction. There's always going to be noise. I'm trying to identify managers that initially are in the West that have proven themselves, CTAs are a niche, bring them to China, let them prove themselves. And now with the QFII laws changing, it's not just raising and collaborating with mainland China investors, it's bringing in Western capital to those Western CTAs that have proven themselves that they can trade China, navigate the nuances, manage risk. Not all of them have been successful. We've taken 10 plus hedge fund managers to China. There's currently 4 strategies that are still live. The other 6 that are not live, no fault of their own, they didn't blow up. How this works is we get a small allocation in China. There's certain risk and return expectations from their investors, as there should be. If you're not coloring between the lines, there's a redemption. If you meet expectations or exceed expectations, you're going to get more money. That's been our business in the past. What excites me about the future is meeting, vetting, performing due diligence on mainland local managers, not CTA right now. I have that covered, at least for the time being, but meeting with convertible bond managers, fixed income managers, equity high frequency, market neutral. Some of these traders were educated in the West. Some of these traders manage large books in the West. A majority of the managers I met with have a pedigree. And that one sharp in the US, that's the floor. There's 1.5 sharps. There's 2 sharps. There's such a massive opportunity.
So let me ask you this, and maybe let me frame it. I had a conversation with, and you know, William from Grow Asset. We were talking about just the demographic of talent onshore. And I'm not sure if this is worth pressing into, but last I checked, there were roughly around 23,000 registered hedge funds in China. And by hedge funds, we're talking about private funds. Half of them are private equity. The other half are hedge funds, meaning they're trading listed securities, including CTAs. So that's roughly about 10 to 12,000 hedge fund managers. That's a pretty massive number. Last I checked, Eureka Hedge total database runs to the tune of around 16,000 or so registered hedge funds globally. And here you have one country, 10,000 managers. 2 questions. One is there talent? It seems like a really big pool. And what kind of talent, what kind of strategies are you seeing that you can draw into your offshore allocator pool?
Let me start by saying I'm a huge fan of William Mon. Clearly, he's doing something right. I think Grow, where he's the CIO, they have about 800 million USD equivalent. Their 2 largest shareholders, household names, Lighthouse, Julius Baer. I'm a huge fan of that guy. He's the only guy that sleeps less than me, and he's always on. I'm a huge fan. So let me start there. The 10 to 12,000 managers is a little bit misleading because one firm may have 50 different strategies, and 5 of the strategies may be the identical strategy, but they have a different mandate. So it's the same PM. It's a little bit different fee structure. It's running at a different volatility level, or they've excluded 5 markets, but it's the same principles. My job is to find that needle in the haystack and find that top 5-10% quartile. And we do that through a screening process. Part of my trip, which I hadn't spent any time during COVID, I hadn't been to mainland China since 2019. I just was there in November for 2 weeks doing due diligence, meeting with managers, meeting with investors, asking the difficult questions.
So this is a really good topic. Let me stay here. What is it that makes due diligence on onshore China managers more challenging than, say, in North America?
I mean, just to unpack what I said, one manager may have 50 strategies and you think you're allocating to strategy A, and when push comes to shove, you're getting strategy J. Really digging into who their prime broker is, if they have daily transparency, what the liquidity is, if you're getting preferential fees. I don't think it's that different than the United States in terms of really looking under the hood. What is their risk management protocol? What's their disaster recovery? Do they have risk rules in place? Or if it's a 5-person team, what is everyone's roles and responsibilities?
But is discovery more challenging?
Say that again?
Yeah. Is the discovery process more challenging? Because These are still managers that have audited reports on, they still have custodians, right? They can provide track record. To your point earlier, they might have 50 strategies. I think it's because there's a cap, right? There's a cap on number of investors per fund.
Yeah.
Whereas offshore, we can have unlimited. What is that cap? Is it 50, 200? I can't remember.
I think it's 100. Don't
Right.
quote me on that, but I think it's 100. So yeah, if you have a number of investors, you might have to just set up a new product, same program, just you've hit that threshold.
So if I have 50 of these strategies, each of them are supposed to be identical, but they're not. So how do you do it? Do you spot check? Do you ask for all the P&Ls for all 50 strategies, assuming that they're the same? Or how do you?
My process is I generally get a sample account, and it would be ideal if I don't get it from the PM. I get it from the auditor or the fund admin, or get it from both and cross-check it. Doing due diligence, you can't do enough of it. We also want to look at, if they have a definable edge and if they can quantify it. How do you differentiate yourself from your peers? Is the track record live? Your worst drawdown is going to be after I allocate, size the trade correctly, because historically a CB manager's worst drawdown is 3%. Doesn't mean the system's broken if they draw down 5%. Probably not. It's a new max drawdown 60% greater than their previous drawdown, but they're down 5%. And what's so fascinating to me is the lack of correlation with a lot of the convertible bond strategies that I'm looking at. It's not that they're lights out making 30, 40, 50% a year. It's they're managing risk, and they're non-correlated to the high frequency strategies I'm looking at, the CTA strategies I'm looking at, the fixed income strategies I'm looking at. So in a perfect world, and this is the same advice when I work with investors in the United States, I'm going to try to deliver this same message when investors look for China access, is you can pick one horse, but what I'd prefer is work with groups like us and let us build you a curated portfolio of non-correlated alpha. Chances are, if you have 3 managers, 5 managers, they're not all going to be making money or losing money at the same time. But if you can diversify by trade duration, by volatility level, by trading strategy, doesn't mean you're going to be successful, but it increases the probability that you may be successful.